in addition to these 3 lines of defense. Then we have studied something about the credit risk, and under the credit risk, we have actually divide the credit risk into 2, concentration risk and default risk, and then we move to the related party transaction. And then we have defined who is the related party and any the consequences could arise from the related party transaction. Then after that we have studied about the liquidity risk, and then we move to the market. Under the liquidity risk, of course, we have studied about the ALCO, the Asset and Liability Committees, which is responsible to manage the interest rate risk and market risk of the banks and financial institutions, which we have studied. And after that, then we have studied about the market risk. Then that is actually we didn't study much about the market risk, because market risk is sort of 2 components, the interest rate risk as well as equity price risk. Then we move to the risk-based capital, and I said that rather than deciding or fixing one capital to the all the banking institutions or financial institutions based on their risk level, they can categorize this risk capital the capital level based on their risk. If some companies which are having the business with less risky assets or which deal with the less risky assets, then they may they can have the comparably lesser capital than the banks or financial institutions which are having higher risk-based capital portfolios. Then those banks and financial institutions should have higher capital, because to absorb the risk arise from the risk. So that is the concept we call as a risk-based capital, where I have introduced you all that the capital adequacy ratio based on the Basel Accord. Then now in Sri Lanka, the Basel III is being implemented, and based on the Basel III, this minimum capital, the risk-based capital level, is decided by the banks. So these are the things we have studied during the last 2 classes. So I am going to today class, of course, what I have planned is there are some other risk governance part or risk governance structure I have to introduce. Then after that we will go for a past paper questions and answers. I like to bring you a kind notice that again, or just reiterate that if you are clear in the risk management, you can earn 20 marks in the exam if you are clear. So so you can have a clear understanding about the risk management. Having that known, before going to the today's topic, do you all have any questions? Then I can answer, of course. If you all have any questions, I can answer. Any questions? Okay, then I'll move into the today's topic, which is, first of all, we are just talking about the risk management. In the risk management, the internal control is most important. Even there are some short notes questions in the past papers about the internal controls of the banks as a part of the risk management. So what is internal control? The internal control can be defined as a system designed and introduced and maintained by the bank's management and top-level executives to provide a substantial degree of assurance in achieving business objectives, complying with the policies and laws, maintaining efficiency and effectiveness in regular operation. This is sort of definitions about the internal controls. But we can have a simple understanding about the internal controls. Rather than going with the definitions, if we have the simple understanding about the internal controls, then it is easy to memorize or easy to keep it understanding what is internal controls. In any banks or financial institutions, you can notice that there are several internal control measures introduced. For example, if the bank wanted to make a purchase, okay, they can't just go and make the purchase from the customer or from the suppliers. For example, if they wanted to purchase sort of computers or printers for the use of banks, what they have to do is actually they have to decide what are the number of computers required for a particular bank or particular period. Then they have to estimate what would be the allocations, whether they have a sufficient budget or cash allocation to buy those computers. Then, even though they have decided, okay, how many computers we are going to buy, there is a budget allocation, they can't just go and buy it. What they have to do is they have to call for a quotations or bid opening process. If it is a large amount, then they have to go for a tender procedures. Or if it is a 1 or 2 computers, then they can call for a quotation. Then based on the quotation, they have to select one quotation, and that quotation has to be approved by the particular officer who is responsible for that purchasing. Then after approving, they can place the purchase order. So once goods is received, then stockkeeper or that the person who is in charge to the stock has to confirm that the goods has been received. Then the payment will be made. Then for the payment also, there are approving, certification, and payment. There are several procedures. So this is one purchase of the computer. But there are several internal control procedures get involved for this particular purchase. Why these internal control procedures, this type of internal control procedures or some defined procedures are take place? Because there should be some sort of control to ensure that there is no fraud or errors take place. So that is the purpose of the internal control system. So it can be designed to introduce by normally the internal controls are introduced by the top management. So in the risk management, if it is a centralized risk management department or the top management, they will introduce the internal control for each and everything. Then these the first line of defense, that means the divisions or branch level, the branch managers is responsible to ensure that these internal control processes are in place in the banks and financial institutions. That is the first line of defense. The first line of defense is in charge for the implementation of internal control system. So the second line of defense or risk management, centralized risk management department will implement or will introduce this internal control system in the branch level or department or division level. But this the first line of defense, it means the branch managers, they have to ensure that all the internal control procedures are in place. Then who will give the assurance that the internal controls are implemented properly? Because the one part is the second line of defense is implementing, and first line of defense is following the internal control system, and they are introducing, and first line of defense in implementing the internal controls. So who is the party has to give the assurance that proper internal control system has been implemented in the bank, or it has been followed by the bank in each and every operation of the banking business? Who? We have studied about that. Of course, This is the third line of defense, has to give an assurance that all the internal control procedures are in place and properly followed by the first line of defense. Who is the third line of defense? The internal auditor or chief internal auditor is responsible for giving assurance that there is the proper internal control procedures are in place. So in the risk management, the internal control is more important aspect, which ensure that all the transactions are happen in a proper way. So in the internal control procedure, there are several steps or several segregations in the internal control procedures. First one is segregation of duty. Why the segregation of duty is introduced? Because to avoid the errors as well as fraud. Because if there is something, or for example, if a bank or finance institution has to make some 10,000 rupees, sometimes there may be 100,000 rupees payment. It can happen due to the errors as well as fraud. There may be two chances, error or fraud. So that to avoid that situation, to error or fraud, what they are doing is segregate the duties. For example, if it is if a bank wanted to make some 2 million payment, what they have to do is some cashier receive that slips or request form from the customers. Then if it is the amount is more than the expected amount, then there will be a second officer who will approve that this payment can be take place to that particular customer. So that particular duty is segregated into two layers. When there is a procurement or something, this is segregated into several layers. Somebody has to approve, somebody has to certify, somebody has to ensure that the goods has been received, somebody has to make the payment. Likewise, the one process has been segregated into several officers. Why this segregation of duties? Because to avoid the errors of fraud. That is one. Another internal control procedure could be the access controls. Even in our central bank, we have access control in the front of the bank. So likewise, there may be access control in your particular bank, so the finance institutions anywhere. And of course, in some of the finance institution, the particular officers can enter into their particular divisions or department only. They can't enter into other departments or other divisions. Access control. There's a restriction for access. For example, especially the front office, you can see that. Or in the IT department, you can see that there are several access restrictions. Outsiders cannot enter into the server rooms. Access control. That is also sort of the internal control procedure. So the first one is segregation of duty. Other one is access control. These are the internal control procedures. And third one is physical verification. Every year end, there will be a physical verification of the stock. Even the bank and finance institution, end of the day, they will have the sort of physical verification of the cash in the branch level. Okay, they have the this much of opening balances, this much of payment they have made, and this much of cash inflow, and finally this is the closing balance, whether they have the particular money in the closing balance, physical verifications. Generally, the internal auditors comes, first they will do is, they will go and close the cash book and the cashier, and they will just start to count the money, whether the particular the book balance or the computer balance is tallying with the physical cash. So physical verification also could be considered as one of the internal control procedures. scandalized document and the documentation, scandalized documentation is also one of the. That's also all the documents can be properly keep and maintain. In the government banks, of course, in the, even each and every banks, they have to maintain 6 years their documents. Within 6 years, they should be able to produce those documents. If it is a government institution or government bank, they have to maintain 12 years under the FIU rules. Then what is FIU? Financial Intelligence Unit. So they are the people in charge for the anti-money laundering and terrorism finance. So under that, they have to, all the banks and financial institutions, even other institution has to maintain the 6 year documentation for 6 years. If it is a government institution, 12 years, of course. An approval authority requirement, that is also one of the internal control. For each and every payment or the payment above the certain level, if it is a more than 500,000 or more than 1 million level, then the second officer has to make the approval to make that payment, sort of authorization. So you can see that if we want to withdraw some large amount, normally the cashier will pass our savings books into the second officer. Or if we wanted to withdraw our fixed deposits, then the cashier will pass that our certificates and all the calculation to the second officer. Second officer will go through it, and then he will approve. That approval authority requirements. So these are the sort of the internal control procedures we can follow. It segregation of duties, access control, physical verification, scandalized documentation, and approval authority requirement. So now I think you will have an understanding that the internal control management and internal control, what are the type of internal control procedures are there. And as I mentioned, internal controls will be introduced by the second line of defense, the centralized risk management, and implemented by the first line of defense, the branch managers level, and the internal auditor will give an assurance that the internal control systems are properly implemented or properly take places in the banks and financial institutions. Do you have any questions to ask from me? Any questions you all wanted to ask from me on internal control or risk management? Okay, then I will just move into the other topic, which is that internal and external audit, which everybody may know. If you all work in the bank and finance institution, you all may know that the internal and external audit. But why we are studying it? We are just there's an in the past paper there are questions about the internal and external audit comparison. In the short notes, actually in the financial institution management, there are 8 questions or 9 questions. Sometimes it's 9 questions. The first question is compulsory, which have 10 subsections. Each have 2 marks, and there are other 6 or 7 structural questions, and one will be the short notes questions. Generally, that is the practice. One of the questions will be short notes questions, and you can earn the marks through the short notes questions, because that is one of the easy way to earn, because it's just to compare the 2 concepts or something. Just compare the concept. If they ask about okay, compare the internal audit and external audit in the short notes, first what you have to do is, what is internal audit? You have to say what is external audit. Sometimes there is any comparison or any differences, you have to just mention in the 3rd paragraph. This is the main difference in these 2 concepts. That's all. Then you can earn the entire 5 marks or 4 marks from the for that particular questions. Because it's always better if there is a short note question and you know those things, then it is better to choose that question. Then you can earn the marks through that questions. It's easy. So there are questions about the comparison between the internal and external audit. What is internal audit? It evaluates the company's internal controls, including its corporate governance and accounting process, and ensure compliance with laws and regulations and accurate financial reporting, as well as helping to maintain operational efficiency by identifying problem, correcting lapses before they are discovered in an external audit. Normally, the internal auditor or internal audit department, which is responsible for ensure that or giving assurance to the top management that there's an internal control procedures are in place. So they will evaluate time to time, they will evaluate the internal control of the company. When they are evaluating the internal control, they will evaluate the corporate governance, because I think we will study about the corporate governance. This is also one of the corporate governance is one of the separate topic in our financial institution management subject. So in the corporate governance, they will ensure that all the corporate governance systems are in place, whether it has been properly implemented. And particularly they will concentrate on the accounting process, whether there are some 4 principles are implemented or the duties are segregated, whether all the inventories are maintained properly, whether physical verification, cash and all the accounting procedures they will, and as well as the accounting procedures, how these accounting entries are take place and all the things they will ensure. And compliance with the laws and regulations, whether the bank and financial institution comply with all the laws and regulations, they will ensure. And accurate financial reporting, because when the financial reporting only have a disclosure requirement, or sort of convey the financial position of the banks and financial institution to the stakeholders. So they will check whether the financial reportings are accurate, and as well as helping to maintain operational efficiency by identifying the problem and correcting lapses before they have been discovered by external auditors. So this is the internal audit function. And what is the external audit function? Everybody knows that this is mostly independent people. A periodic audit conducted by independent qualified accountants to assure whether the accounting records are accurate and complete, prepared in accordance with the previous provisions of relevant accounting standard, and statement prepared from accounting present fairly the organization's financial position. Actually, external auditors' duty is giving an assurance or giving sort of opinion to the shareholders whether the organization financial positions are reflected by the financial accounts or financial statements. And these external auditors are doing their job as an independent qualified accountants, as an independent, because they will have the higher degree of independency when they are doing the external audit. Generally, the external auditors are appointed by the shareholders at the annual general meeting. Some banks and financial institutions, time to time, for example, if they appoint an external auditor, that external auditor may continue for next 3 years period or 5 years period. After that period, the annual general meeting, they may reappoint that particular external auditor, or they may appoint a new external auditor. So since the shareholders appointing that, and these people having the responsibility of giving the opinion to the shareholders and stakeholders, including the stakeholders, including shareholders, whether these financial organization financial positions are reflected by the financial statements. So they just compare this accounting with the accounting standards as well as statements prepared by accountants. So if there's any questions about the comparing the internal and external audit, you have to write it this para and as to say the additional information compared to the internal auditor, the external auditor will have more independency. And internal auditor is responsible to report to the top management of the company. But external auditor has the responsibility to give the report to the shareholder of the company. So just compare those two things and finish it off. This is called internal and external audit. Understand? Any doubt you all wanted to ask or anything you all wanted to ask from me? I think it is better to have sort of interactions in the class. Whether I like to have a feedback whether you are understanding that, because it should not be a one-way communication. It should be a two-way communications. So better if you have any questions or any comments, please convey through the inbox chat, or even you can unmute the microphone and then you can ask the questions. I am ready to answer. Okay. And then if we have seen the internal audit and external audit, and then next one is that we are going to move into the some sort of reporting structure or governance structure in the risk management. In a bank or financial institution, there are different type of reporting structures. Generally, we can observe three type of reporting structure in a bank or financial institution. The first reporting structure is administrative reporting structure or administrative reporting. What is administrative reporting? Generally, the administrative reporting is a general reporting. It means a branch manager will report it to the regional manager, and the regional manager may report it to the AGM, and AGM may report it to the DGM, and DGM will report it to the CEOs. Which is generally all the administrative report, they will report it to their hierarchies. Maybe manager, senior manager to regional manager to AGM to DGM to CEOs. The administrative, this reporting will take place through the administrative hierarchy of the bank and finance institutions. So reporting establish a clear line of authority between the position units in the regional hierarchy, organizational hierarchy. For example, if it is it will be a very clear organization structure, or the hierarchy structure will be created, or reporting line will be created. If it is the bank or finance institution in the Western province, they will have a well-defined reporting line. Same like if a bank has in the central province, they will have the same, or they will have the different, because their regional managers are different, but well defined the administrative reporting will be there. And functional reporting means which is not based on their hierarchy, administrative hierarchy. This is based on their functions. This reporting establishes a connection between the position or units at different management level based on the specialized nature of the function for the mutual responsibilities chart. For example, let's take an example that there's a customer, he requests a large amount of loans and advances from particular branch. Okay, then what will happen is, rather than going through the reporting, administrative reporting, here sometimes functional reporting will take place. Functional reporting means these particular loan requirement will be from the particular loan division of the particular branch will directly forward to the regional credit committee. And in the regional credit committee will analyze that credit evaluation, and they may forward it to the DGM credit or AGM credit directly. And the credit again, that AGM credit will evaluate it, and they may report it to the particular the centralized credit evaluation committee. It is based on the amount of loans and advances, not every loans and advances. If it is a large amount, 100 million, 500 million amount of loans and advances, the facilities, then that will take place through the functional reporting. Rather than going through the manager, senior manager, regional manager, that level, it will go through the functional level. It means the credit loan division of the particular branch will report it to the credit committee of the region. And the credit committee of the region will report to the AGM credit. He may be different person from the normal AGM. So he will just report it to the AGM credit, and AGM credit may forward that to the centralized credit evaluation committee. And that approval may be granted, then that will routed through those functional reporting level. This functional reporting can be observed even in the audit or risk management function. I have already mentioned you, each and every branch, there may be a risk officer. So if there is any particular risk has been identified, that risk officer may report it to the centralized risk management department or chief risk officer directly, rather than routed through this administrative or functional administrative reporting. Right? It's a function, risk management function. So the particular risk officer may directly report it to the risk management department in particular banks and finance institutions. The particular risk management department will escalate those risks into the risk management committee or board subcommittee directly. And based on the gravity of the issue, they may directly report it to the board even. So which is the functional reporting rather than administrative reporting. The administrative reporting is a very clear hierarchies are defined, very clearly defined. But functional reporting is different, which is based on the function wise. So even within a branch, the credit function may have different reporting line, or the risk management function may have different reporting line. Likewise, there may be different reporting lines. That is called functional reporting. And risk reporting also, as I mentioned, the second example, that is also sort of reporting if the risk officer communicate that risk to the centralized committee. So there are different type of risk structure: administrative reporting, functional reporting, and risk reporting. And there are some committees which is responsible for risk management function of the banks. In order to enhance the efficiency of decision-making process and to focus the specific area of business, the board of directors could establish certain specialized committees. Because end of the day, the board of directors will be responsible for overall risk management function of the bank or overall function of the bank or financial institutions. But if it is a large institution or large bank, the board of directors cannot interfere or cannot deal with each and every aspect of the banking operation or finance institution operations. What they will do is they will form a subcommittees. The internal audit subcommittee, compliance subcommittee, the risk management subcommittee, and credit subcommittees, and remuneration subcommittees. Likewise, based on the issues, they will create, or based on the functions, they will create specialized committees, board subcommittees. And the number and nature of the committees depend on the many factors, including size of the bank, nature of the business areas, and risk profile. For example, it's a multinational bank or financial institution. They are having the branches all over the world. Then the number of committee members and their functions will be totally different from a rural bank's risk management committee, because there are very few branches, and that all the functions may be highly centralized. They may not have the large committee, only 1 or 2 members in the only 2-3 members in the committee. And nature of the business, if they have some banks only deal with the customers, some are having investment arms and investment banks, different type of financial business. If they get involved, their committees will be different. And when board appoint a committee, it should avoid the possibility of conflict of interest. What is the meaning of conflict of interest? Actually, there are questions always. What is the meaning of conflict of interest? What is the meaning of conflict of interest? What is the meaning of conflict of interest in the bank and finance institution or any company? What is the meaning? The conflict of interest. Can someone make your answers or send your answers through the inbox, chat box? What is conflict of interest? Come on, guys. What do you mean by the conflict of interest? Even you can unmute the microphones and talk, because this is always there is a questions in the conflict of interest. What is the meaning of conflict of interest? If a person's personal interest is contradict with the bank's or financial institutions' overall interest, then there will be a conflict of interest. If a person's personal interest, I'm repeating the things, if a person's personal interest, it may be a director or it may be a CEO or whoever, it may be a DGM, the particular person's personal interest is contradict with the financial institution's overall interest, then there will be a conflict of interest. How can we understand in very clear manner? For example, a bank director who is a director of the particular bank X, and he is having the IT company, he is owning IT company A. So the bank X director is the director of the bank X, and as well as he is the director and owner of the IT company A. Now this bank going to buy or purchase some software, particular software from the outsiders. Then this particular director trying to sell his product to the bank, where the particular director's personal interest will be earning more profit. As a IT company owner, his personal interest may be earning more interest or selling the product at a higher price. That may be his personal interest. But the bank's overall interest is purchasing the software in a lower price with the quality, but same the quality product at a lower price. So here the particular director's personal interest has a conflict or contradict with the bank's overall interest. Bank's overall interest is purchasing the good quality product at a lower price, but particular director's personal interest, not as a bank director, as a personal interest, selling the product at a higher price to earn the higher money. So here the particular director's personal interest is conflict with the bank's overall interest. So when a bank appoints a committee, it should avoid a possible conflict of interest situation. I can explain other way. If a AGM credit, for example, if a DGM credit, there's a DGM credit, he is appointed as the member of internal audit committee as well. In that scenario, if the internal audit department or chief internal auditor finds some findings, some good findings or some errors or fraud in the credit risk operations, then what will happen? The particular DGM of the credit may avoid to report that, or will avoid to report that particular the bad incident or the fraud or error, because that may be affect the other post, the DGM credit post. So his personal interest will have a conflict of the bank's overall interest of maintaining system and procedure, or maintaining 0% fraud will be conflicted with the particular AGMs or DGMs, the post, the objective, personal objective. There's a conflict, because as a DGM credit, he has to show the performance in the credit performance, as well as member of the audit committee, he has to find the mistakes in the operations. So what will happen is, when they are an audit in the credit operation, there will be an unbiased situation, or biased situations. So the interests are getting conflicted. So when the bank top management board of directors appoint a committee, it should avoid a possible conflict of interest situation. This is the committee responsible for the risk management. So as a summary, I like to say that the risk management, the bank board of directors may appoint in a bank or finance institution, board of directors may appoint several committees, and number of members and size of the committees and the number of committees are depend on the large size of the banks and nature of the business. And then when they are appointing the committee, there should not be conflict of interest. This is the takeaways from this slide. Okay, understand? Okay, then there are several committees in the risk management. Board of directors, of course, they are not a committee, they are the top people, they are responsible for risk management functions. And board audit subcommittee, which is the committee which give an assurance there is a proper risk management function in the banks and financial institutions. So that committee also responsible for the audit the risk management function. And then board risk subcommittee. Board risk subcommittee is responsible for the entire risk management function of the banks. And the credit committee is responsible for the credit management, credit operation of the banks and financial institutions. And then the asset and liability committee, ALCO, which is very famous committee in a bank and finance institution, which is responsible for managing the balance sheet of the banks. What are the things in the balance sheet of the banks? Assets as well as liability. So they are the people responsible for managing the assets and liability. So that's what they are calling as a assets and liability committee. Which committee we have studied we have discussed in the last class. What is the function of the asset and liability committees? They are mainly deciding the interest rate for the deposit, the interest rate for the loans and advances. They are in charge of the managing the liquidity mismatches, and all sort of things are managed by this assets and liability committee. and then investment committee, which is responsible for investment made by the or making by the banks and finance institution. And these days IT steering committee also similarly important things which manage the IT related aspect of the banks and finance institution. So there are different type of committees in the risk, related to the risk management in a bank and finance institutions. You will have, and I think we will discuss this already. We have discussed about the ALCO and the other committees. We will discuss about their roles and responsibilities. We can discuss about it. So these are the basically the committees which is responsible for the risk management. Board of directors, board audit subcommittee, risk management subcommittee, credit committee, ALCO, and investment committee, IT steering committee. IT steering committee is why IT steering committee is responsible for risk management, or which area of the risk management? Can someone answer that? The IT steering committee, whether the IT steering committee is responsible for risk management. If so, what is the area they are, what is the type of risk they are managing? Can someone answer the questions? IT steering committee managing which sort of risk? Yes, technology risk, and particularly the operational risk. As I explained to you all that the operational risk are managed by the IT steering committee, because when I am saying that operational risk or technology risk, the operational risk, the technology risk is the part of the risk. I said that system interruptions. It is a huge risk for a bank and finance institution these days. And if there is a breakdown in the system, or if somebody hacked the system, then that will create a lot of consequences to the banks and finance institutions. So this IT steering committee particularly managing the technology risk or operational risk. We can say that operational risk or technology risk, both are correct. So the IT and then investment committee, it's again the investment and IT. So these are the committees normally responsible for risk management of the banks. Any questions you all wanted to ask? Otherwise, I'll just move to the other slide. Before moving to the other slide, if you all wanted to ask any questions. Okay, then the responsibilities of the board of directors in the risk management. Because, okay, we say that there are some committees or there are some bodies which are responsible for risk management, and what are the responsibilities, which is actually I need not to much explain to you all this, but you all can have some idea. First one, decide on risk appetite and risk tolerance level. I think not last class, previous class or last class, I think I have explained you what is the risk appetite. The risk management functions, a bank and finance institution or any other company, first they have to decide the risk appetite. What is risk appetite? The level of risk they are ready to accept for a particular time period, or from particular investments, or from particular operation of the bank. The risk appetite is the level of risk the bank is willing to take at the particular related to the particular operation of the banking business or financial business. And I gave the example that if a particular there may be X bank and Y bank, X bank may ready to take the 100 million loss in a particular year or particular investment, but bank B may ready to take only 50 million losses from the particular investments. Even though the investments are equal, some banks may ready to take more investments. They are based on their risk culture and their business models and all. So the risk appetite decide, okay, what level of the risk they are ready to take in a particular operation, business operation. And risk tolerance is connected to the risk appetite, which is even though they have they have decided 50 million and 100 million risk appetite, there are some tolerance level. Okay, even though 50 million, they can go beyond that 5% above and let's say more or less that plus or minus the tolerance level. So first, the board of directors, with respect to risk management, the board of directors has to decide what is the risk appetite and what is the risk tolerance level for a bank or financial institutions. First, they have to decide. This is the responsibility of the board of directors. They are the people who have to decide. Actually, India risk management functions will start by deciding the risk appetite level or risk appetite and risk tolerance level. And so that's the board of directors is the responsible. Then second one is define the risk governance structure. This is also board of directors other responsibility. What does it mean? Actually, I have explained you there are risk governance framework, and that based on the risk governance framework only we can say that there are silo based risk governance framework or integrated risk governance framework. The bank has to decide which risk governance framework they are going to implement in the bank or financial institutions, or silo based or integrated based. If it is integrated based, so how they are going to appoint the board subcommittee and chief risk officer and centralized risk management department and each units, even the how they manage the financial risk of the banks and financial institutions. They will decide structure, governance structure. Okay, what is the reporting line and what are the committees responsible? All that structure there, the governance structure will be defined by the board of directors. This is one of the responsibility of the board of directors with respect to risk management. The other one is formulate the policies and procedures. Even though the risk management policies and procedures are introduced by the centralized risk management department or implemented by the business units, the overall formulation of the policies and procedures or approval of the policies and procedures are lie with the board of directors. Board of directors has to formulate the policy. Okay, with respect to risk management, these are the policies will followed by the particular banks or finance institution. By the way, every banks and finance institution will have risk management policy statement within them. Based on the risk management policy statement only, they will manage the risk of the particular bank and finance institution. Those risk management policies and procedure should be formulated and approved by the board of directors. Understand? And create awareness on risk management. This is also responsibility of the risk management department. Oh, sorry, the board of directors. Because in the risk management, it is most important to create an awareness. Because awareness play a critical role in the risk management. Each and every officers are expected to have an awareness on risk management. And the risk management should be created as a culture. Even in the foreign banks, you know, the Malaysia and Singapore, the finance institution, they are having a day called Risk Management Day, where they arrange several seminars and several awareness programs and all to create an awareness on risk management. So the board of directors has the responsibility on that. And encouraging organizational structure, risk culture also is a responsibility of the board of directors, encouraging the risk culture. And establish a risk oversight function. So because they establish risk oversight function in the means the centralized risk management department, and this is more or less related to the risk governance, but oversight function in the sense formulate the policies and all. Then there somebody has to oversee that. So the chief risk of appointing the chief risk officer, and then the risk management department give their freedom to oversight the risk management. So those things are responsibility of the board of directors. And periodically review the risk management functions, because the risk management function, once they have introduced, they can't continue that risk management function forever, because there are the changes in the environment or business models. So based on the changes, they have to change the risk management functions as well. So time to time or periodically, they have to review the risk management functions. I think I will remember that in the risk management process, there are 4 processes in the risk management. One is identify the risk, analyze the risk, monitor, control the risk, and monitor the risk, because the risk management function should be continuously monitored. Likewise, the board of directors should periodically review the risk management function of the bank and finance institution. So these are the basic things you are just given, because why I'm explaining you all that, then it's easy to you to keep remind. And as I always mention you all that there are 2 points for studying a subject. One is getting knowledge, that is the first one. Second one is pass the exam. So to get the knowledge, you have to have sort of overall knowledge, overall view. Because what you all can do is you all can just memorize it and write it in the exam, but no point. Actually, you must have some knowledge. You have to gain some knowledge based on by studying these topics. That's why I'm explaining you all that in detailed manner. Any questions you all wanted to ask from me? Okay, then I'll just move into the other one. The responsibility of the board risk subcommittee. So we are coming down from the responsibility of the board of directors. Then we are moving to the responsibility of the board or risk subcommittee. The board risk subcommittee means there may be some board members, and in addition to the some board members, a chief risk officer as well as some representative from the banks will be in the risk subcommittee. And the risk subcommittee is the next to the board of directors. They are responsible for the overall risk management function of the bank. So the first responsibility, assess risk profile and key risk area. They have to identify and assess what are the key risk area for these banks and finance institutions, because it may different banks to bank. For example, some banks may have a risk for their credit portfolio. Their key risk is the credit. But for some banks, the key risk could arise from the investment side. Or some banks may have a large individual portfolio. So their key risk may be in different way. It could arise from a different way. If you see some foreign banks, they are deal with the top high rated corporates. So their risk may be in different categories. So but they have to identify and assess the risk profile and key risk area of the bank and finance institution, and then recommend the board and adoption of risk assessment and risk procedures. So first they have to identify the risk, and what they have to do is then again they have to recommend the board and adopt the risk management assessment and risk procedures in the bank and finance institution. That is another important. And third one is articulate the policies for oversight the management of risk. Because It's no point. Okay, there may be several good policies, there may be good procedures, but if they have not implemented properly, no point. So somebody has to oversight it. So articulate the policy for oversight and management of the risk. And then examine and determine the sufficiency of the internal process. That is what actually the audit department doing. Check and determine. This is also the responsibility of the board risk subcommittee. They have to examine, they have to see, okay, we have introduced this much of internal the control, so this much of risk management process to the investment function, whether that is sufficient, internal process are sufficient, especially the operational risk. The risk management committee has to say or has a duty or responsibility to examine and determine the sufficiency of the internal process. For example, the cash handling of a bank or finance institution. They have, if it is a bank, they have to handle the cash. Maybe they have to transfer to branch or head office to branch, or a branch to ATM, standalone ATMs. They may have to handle the cash or transfer the cash from one place to other. So cash handling is one of the risk management area. So they have to examine and determine whether the internal processes are sufficient. Is there any lapses? So that is also one of the responsibility of the board risk subcommittee. And assess and recommend the board acceptable level of risk. Because there may be the different risks. I have already mentioned you all that we can't avoid the risk, but we can manage the risk, or we can mitigate the risk. So if we mitigate the risk, there is an acceptable level of risk which can a bank or financial institution could accept or could accept it. So that the mitigation level or acceptable level of risk could be decided, assessed and recommended. And implement the risk management framework and internal control system is one of the responsibility of the board risk subcommittee. And report the trends on risk profile, report specific risk on the status of the risk management process is also responsibility of the risk management board risk subcommittee. So basically these are the responsibility of the risk management committee. So now you all can understand. First, the board of directors, under the board of directors there's a board risk subcommittee, and board risk subcommittee has the responsibility of assessing the risk profile and then risk assessment, adoption of risk management process, and recommended, articulate the policy, and examine and determine the sufficiency of the internal process, and assess the recommend the acceptable level of risk and implement the risk framework. These are the responsibilities the board risk subcommittees are having. Do you have any questions? Okay. Then the responsibilities of audit committee. So this is also part of the risk management process, because auditors are the people, or internal audit committee are the people, they are giving assurance that the audit is in place in a particular bank and finance institutions. So what they have to do is they have to ensure the evaluation of the risk faced by the organization. So they have to evaluate or ensure the evaluation of what are the level of risk faced by the organization. They have to ensure that. And assess the internal control objective and whether these objectives have been met. The internal control objective, because there may be, if it is the internal control, there should be some objective, and whether those internal control objective are okay, that they have to assess, and then these objectives have been met in their day-to-day process and risk management. They are the people has to assess it, that they are responsible. And review the risk assessment by the internal auditors as well as management. Review the internal audit assessment, risk assessment by the internal audit as well as the reviewing process is the responsibility of the audit committee. And understand the key internal control issues and monitor process on these issues. Actually, in a bank and finance institution, understanding the key internal control issues is most important, because in any institution, any bank or internal finance institution, there may be weaknesses in the internal control, or there may be issues in the internal control process. So they have to understand it, because once they understand the internal control weaknesses or issues only, they can recommend that, or they can find that weaknesses and monitor the process of the issues, and oversees the function of the chief internal auditor, and internal audit department is the responsible the audit committee. So audit committee will have the direct control over the chief internal auditor and internal audit department. So they have to have that overseeing function, and recommend the board on issues related to internal control and internal and external audit. Actually, these people will add at the audit report, they will have a recommendation on the related to the internal controls, and actually the audit committee will have a responsibility of recommending the external audit to the manager. So these are the responsibilities of the audit committee. Any questions you all wanted to ask? And responsibility of the credit committee. Of course, the purpose of the committee is to oversee the credit and lending strategies and objectives. Actually, today's class, of course, it's maybe sort of boring because there is nothing much to explain, because these are responsibilities clearly articulated, or these are theoretic, sort of theoretical matter. So you will have to have these are to keep in mind or memorize it. So the responsibility of the credit committee is the purpose of the committee to oversee the credit and lending strategies and objectives. Advise the board on policies related to credit risk management. Actually, the first purpose of the committee is to oversee the credit and lending strategies. When I am explaining the functional reporting, I explained to you all that if it is a credit operations, generally the centralized credit committee will oversee the credit, whether this risk arise from the credit risk management is manageable to the bank, and whether it is in accordance to the risk appetite of the banks. They will decide, and they have to oversee that, and advise the board on policies related to credit risk management. That is also a responsibility of the credit committee, and oversee the credit risk management, including reviewing internal audit policies and internal credit policies and establishing portfolio limits. It's also credit committee's responsibility. You all may know that if it is a branch level, there may be, for example, if a branch manager can grant the credit to a certain level, for example, if it is 500,000, then the regional manager can grant the loans if it is until the 5 million. If it is the centralized risk, AGM or DGM credit can grant the loans up to 100 million, and if it is above the 100 million, then it may be credit committee. Likewise, the credit portfolio limits are there, and even within the portfolio there may be different portfolio limits. It may be the branch can have a leasing portfolio this much of individual loan portfolio, this much of corporate portfolio. The branch level as the bank as a overall, they are as a portfolio limits. This credit committee is deciding that portfolio limits, and review the quality and performance of the credit portfolio. This is most important, because they had to review the quality and what is the NPL levels, what is the potential risk arise from the NPL portfolio. They are the people as to time review the quality and performance of the credit portfolio. So regularly reported to the senior management board on the issues related to credit risk management. Actually, the overall we can say that this committee is responsible for the credit risk management of the banks. In the risk management related to the credit operation of the bank. So those related responsibilities are the credit risk committee's responsibilities and IT steering committee responsibilities. IT steering committee, as I mentioned, that IT steering committee is mostly related to the technology risk, and IT steering committee is an administrative body that review the monitor the prioritize major IT projects. And major IT project means, for example, if the bank going to introduce co-banking system, or bank going to introduce some virtual banking system or something, the major projects, then this IT steering committee has to review and monitor and prioritize it, and formulate the IT policy for the organization and review at the frequent intervals, and ensure that IT strategy is aligned with the strategy goal of the organization. For example, if an organization has the overall goal or overall objective, that objective and the IT strategy should match with that objective. For example, if an overall bank has the objective that dealing with the, or finance institution has the objective that dealing with the grassroots level people, then this IT strategy cannot have the totally the virtual banking system, because they are going to deal with the grassroots level people or rural people. So in that case, ensure the IT strategy is aligned with the strategy or goal of the organization. So that is most important thing for a IT steering committee member. And advise the board on the IT related matters, especially cyber security of the organization. The cyber security, of course, everybody may understand that these days the cyber security is most important thing in a bank and finance company businesses. There are the IT as IT is in one of the evolving area in the banking operations, and payments are online, and most of the people, more and more people are trying to use the internet-based platform to make the payments. Then at the time, IT has to provide the services, as well as meantime there may be cyber crimes, increasing number of cyber crimes. The hackers enter into the system, and they try to hack they try to get the financial benefit by hacking the system. So at this point, what they have to do is actually IT committee, the IT committee should advise the board on the IT related matter, especially cyber security of the organization. So I think these are the committee's responsibility. We have seen the committee's responsibility first, the board of directors responsibility with regard to the risk management. Then we have seen about the responsibility of the audit committee, and then we have seen the responsibility of credit committee. Finally, we have seen the responsibility of the IT steering committee. Of course, ALCO and all we have already seen. So that's what these committees we have discussed now. Any questions you are having, you can ask the questions. Any questions or anything? Otherwise, I can move to the other section. I have one more, the last sections to move. During these last 3 classes, or today's and last 2 classes, I have several times mentioned the word the Chief Risk Officer, the CRO. The CRO post is much important, or evolving as one of the important posts in the financial institutions in the recent past. In general, CRO is the head of integrated risk management department. He is appointed by the board or a subcommittee. Generally, the chief risk officer, CRO, is responsible for the risk management function of the bank and finance of the institution. Especially at the integrated risk management framework. When a bank follows the integrated risk management framework, the CRO is responsible to manage the risk. If it is a silo base, of course, the CRO need not to manage, because the risk are managed in the silo base. Different divisions will manage their risk at a different level. But if it is an integrated risk management department, he is responsible for risk management, and he is the head of the centralized risk management department, like chief risk officer. And CRO is responsible for risk oversight function of the organization, as which is I have already mentioned to you all. He is a first, even though the bank is approving, the board of directors is approving the policies, they are formulating policies and all. But in the as a department, the chief risk officer or in internal risk, the centralized risk management department has to formulate and give it to the board. Then the board will review and approve it. And even the implementation stage, they have to give the sort of advice to the branch unit, business units to implement the risk management, and they are the people oversighting it. And CRO should not have responsibilities to any operational business line or review the generation function or revenue generation function. Sorry. What does it mean? It means the CRO, the chief risk officer, should not get involved the operational business line or revenue generation function. He should be only the head of the risk officer, or he should only involve in the risk management function. He should not involve with any other operational business line or revenue generation function. It means he can't be the DGM or credit. He can't be the DGM or AGM, or he is involving in the banking operations or revenue operations. He should be only the risk officer or head of risk. He should only the oversight the risk function. Why it is saying? Why he should not involve with the other functions of the banks? Actually, there are questions in the past papers. CRO, why we are saying that CRO should not responsible for the other operational business of the banks and finance institution? Why? Come on, guys. Why we are saying so? The CRO should not get involved with the other function. Because, yes, there's an answer. Because of the conflict of interest. That is the answer. Because if the CRO, the person who is responsible for the risk management, involved with the operational banking operation or other revenue generation, and if there is any issues in the risk management function of the particular organization, operational aspect or revenue generation, he may reluctant to report that to the top management. Then there will be a conflict of interest. The personal interest and the bank's overall interest will get conflicted. So that's why the CRO should be an independent person. He or she should not involve with the operational aspect or business aspect of the bank and finance institution. And CRO should be independent of the business reporting line and maintaining the independent risk reporting line. Actually, for the CRO should have the independent business reporting line. Generally the banks are the finance institution set up like this. The CRO can directly report it to the risk management committee, and if necessary, CRO can report it directly to the board of directors. That independent reporting line will be maintained, because if there is any risk, he should escalate immediately to the top people. And CRO directly report to the board risk subcommittee. And CRO to have access to the information necessary to perform his duty. Actually, like internal auditor, CRO, chief risk officer, also should have the access to any information of the banks and financial operations. Then only he or she can do the risk management function or assess the risk level. So these are the functions we can say. Actually, there are questions in the exam paper about the chief risk officer. So you can just write it like this. And chief internal auditor. Of course, the chief internal auditor is responsible for audit operations, which we know that internal they are in the banks and financial institution. If it is the medium size or large banks and financial institution, definitely there will be a internal audit department. The chief internal auditor responsible for audit operations and process as per the mandate given by the board to ensure that the business operations are conducted smoothly. And chief internal auditor should get involved in the business decision making, should not get involved in the business risk or process of the organization, certification, transaction, approval process, or etc. Actually, this is also same. Again, to avoid the conflict of interest, the chief internal auditor should not get involved business operation or business decision making. Why? Because if he or she involved with the business decision making process, and if there something goes wrong with this business decision process, then he may not escalate that to the top management. So that's why the chief internal auditor also should be an independent person. The chief risk internal auditor should be an independent of the business reporting line. Again, chief risk internal auditor may report to the internal audit committee and through the board of directors. And CAA directly report to the board audit subcommittee as per the audit charter of the responsibility. Here, I am going to ask a question from you all, whether you will have the clear understanding, just to check whether you will have the clear understanding. Let's assume internal auditor and chief risk officer who has the more independency, because we are saying that the chief internal auditor also should not get involved with the banking operation. He or she should be an independent person. Then we are saying that CRO, chief risk officer, also should not get involved in the business decision process or business operation. He or she should be independent. So the both are independent people comparably. But comparably, which has the more independence, whether the chief internal auditor has the more independency or the chief risk officer has the more independency. Who has the more independency in the governance structure, whether it is the chief risk officer or chief internal auditor? Yeah, there's an answer. Both have the same level of independence function. Actually, that is not the correct answer. Actually, why I asked the question is because there are questions in the past paper. The chief risk officer or the chief internal auditor has the more independency than the chief risk officer, because in the chief, even though the risk management department should be an independent and chief risk officer should be an independent person, as a second line of defense, they may have the interactions with the senior management. Because when they implement the risk management functions in the business unit level or in the institutions, to a certain extent, they have to work with the senior management. But the internal auditor, who is he is the person going to give an assurance that all the internal controls are implemented properly, and he is doing sort of internal audit function. So comparably, internal auditor, chief internal auditor has a more independency than the chief risk officer. So if there is any questions, who has the more independency, then you have to say the chief internal auditor has the more independency than the chief risk officer. And of course, the external auditor has the overall, external auditor has the most independency. So if somebody wanted you to rank the these three people into the independency wise, you have to say internal chief risk officer is the below, then chief internal auditor will be the middle, and external auditor will have the top. So external auditor have ultimate independency, but chief internal auditor has sort of independency compared to more independency compared to chief risk officer. But chief risk officer, even though independent, he has to work with the management to implement the risk management. So the chief risk officer will be the low, chief internal auditor, then external auditor. This is the order. If somebody asks, you have to answer. Then I think that's all about the risk management function. If I summarize it, I can just say it thing again. First, we have seen about what is risk. Then we have seen about the two characteristics of the risk. First characteristics, it should create the losses to the institution, and it should be there should be an uncertainty. Then only we call this as a risk. If we know certainly this will happen, then that is not called as a risk. So that is what we have studied. Then we have studied risk management process. In the risk management process, we have studied about the 4 processes: identification, assess, then identifying, assessing, and then controlling as well as monitoring. And these 4 functions will continuously take place in the institutions. Then we have studied about what is the risk segregation into 2 main categories: financial risk and non-financial risk. Then the financial risk, we say that the risk which have more create more losses to the balance sheet, that risk could be called as a financial risk. Generally, there are 3 types of financial risk: credit risk, liquidity risk, and market risk. And the non-financial risk, even though it will create a loss, even though it may create a loss to the balance sheet, but this may create some other risk also, the reputational risk as well as business continuity risk. And that risk, the operational risk, legal risk, strategic risk, and reputational risk, IT risk. Likewise, there are more number of non-financial risks could be identified. And then we have seen that there are 4 causes that could create a non-financial risk, which is system, people, process, and external events. And there are 3 losses could be created. 3 losses could be occur through the through a non-financial risk, which is financial loss, reputational loss, business continuity, or fail to achieve the objective. These type of 3 losses could be arise from the non-financial risk. And then we see that there are different type of risk management framework we have studied: silo-based risk management framework and integrated risk management framework. After that, we have moved that these 3 lines of defense. Under the 3 lines of defense, we say that first line of defense, the business units or branches will be the first line of defense. They are the people owning the risk, and they are responsible for internal control process. And the second line of defense we have studied, centralized risk management department or compliance department, which is responsible for the implementing or overseeing the risk management function in the institution. And then third line of defense, internal audit function, which given sort of assurance to the management, saying that all the risk management functions are in place. Then after that, the 3 lines of defense. Today we have studied then the risk-based capital we have studied, and then again we have explained the financial risk in a very detailed manner. And finally we have studied different risk management, the committees involved in the risk management, the board of directors responsibilities, and then we have seen the responsibility of the board risk subcommittee, internal audit committee, and IT steering committee. Then again, before that, we have studied about the ALCO committees. Likewise, the responsibilities of several committees with respect to risk management function. Then we have studied the internal audit and external audit and chief internal audit and chief risk officer's function. Actually, there are questions about the chief risk officer's function and all. So these are the things we have studied in this class. Do you have any questions to ask that? Because we have studied so far, definitely there may be three options. First, you may understand everything, or you may not understand anything, or you may understand something. If you have understand more things, so even you may not have the questions. But if you don't understand anything, you may not have the questions. If you have only the middle level of understanding, you may have a lot of questions. I don't know in which way you are in, but I'm just giving a chance to you all to ask any question. Don't have any hesitation. You can just type, or you can unmute the mic and ask the questions. Anyway, it's okay. Just give some time. I'll give some time. If you have any comments or any questions. Okay, then if you don't have the questions, then I just, as a last section of the this risk management topic, what I am going to do is I am going to discuss one or two past papers. Actually, I am currently having the 2019 September past paper and 2019 March past paper. So the questions with related to the risk management I'm going to discuss. So these questions came in the 2019 September question paper. The fundamental role of deposit taking financial institution is the maturity transformation of short-term deposits into long-term loans, which make deposit taking financial institution inherently vulnerable to liquidity risk. They are giving some statements and asking the questions from you. First, we understand what is the meaning of this statement. Generally, in the banks, their business is getting the short-term fund and granting the spending that the granting the loans and advances for long term. Then there will be a maturity mismatches. For example, if you have a deposit with the banks, generally banks are accepting 3 months, 6 months, maximum 1 year. Even though they can go for 5 years, they don't go. The most of the 80% or 90% of the deposits are below 1 year deposits. But when they are granting the loans to the customers, generally they are granting the loan for 5 years or 7 years, 10 years. Likewise, the long term. So here they are getting the loan for the short term and getting the deposit for a short term and granting the loan for a long term. So there will be a maturity mismatches because they are just getting the 1 million from a customer for 1 year and then granting the 1 million for 5 years. Then after 1 year, they have the obligation to repay to this depositor. So they have to manage that liquidity. So it creates inherently vulnerable to the liquidity risk. Having that statement, they first ask that the deposit taking financial institutions are responsible for sound liquidity management. Do you agree? And explain the answer. Are you will agree or not first? Whether you will have agreed this or not. Come on. Yes, of course, yes. Because they should have the sound liquidity risk management. Because the nature, the answer is in the statement itself. Because they are getting the short-term funds and granting the loan for a long-term period. So in that case, they have to manage the liquidity. And then there's they have to manage the liquidity risk management, and even you can say that after the 2008 global financial crisis, the liquidity risk management become more prominent, and they can have a sort of a they're more prominent because the 2008 global crisis has been created through the liquidity risk management issues. So that also giving the more responsible for the deposit taking finance institution to manage the liquidity in the sound manner. And then second question is, ALCO, Asset and Liability Committee, play an eminent role in managing the liquidity and market exposure. Briefly explained to you. This is, I have already teaching you. I have already, the last class we have seen the role and function of the ALCO, and if you are writing that answer, that would be the answer for these questions, and you can get 5 marks, of course. And why do you believe that the public confidence in the deposit taking finance institution is more important? Why it is important? Because they are where the customers they are accepting public funds. So when they are confident only, the public will deposit, keep their money with the financial institutions. If you compare to other banks, they have to, compared to other businesses, the banks and finance company should have more confidence to accept the deposits. Otherwise, the people won't deposit the money in the banks and finance institution. That will, if the bank and finance institutions lose their money, then they have to lose their confidence, then they have to lose their businesses. And fourth one is, what are the main factors contributed Lehman Brothers to fail? List the 3 corporate lessons. Of course, the Lehman Brothers, you all may heard about that, which is the fourth largest, which was the fourth largest bank in America. Due to this global financial crisis in, I think it's 15 September 2008, his bank filed for bankruptcy. And this is the biggest bankruptcy in the US history, and the stock market also fall highly, largely in that particular day, where the Lehman Brothers filed the bankruptcy, because there was a investment bank. It was an investment bank, and they have their funds in the subprime mortgages. So when the subprime mortgage crisis started, this bank made huge losses. But even though they made the losses at the time of granting, at the time of filing the bankruptcy, they had the 600 billion US dollar assets and some 600 billion US dollar liabilities. The assets are a little bit higher than the liabilities, but even though they couldn't manage the bank. That is a short story of the Lehman Brothers. And actually, what are the weaknesses? They are corporate lessons, or the list of 4 corporate lessons. What is the lesson means? Even a small bank or bigger bank, they may fail if they don't have a proper system and procedure. And the second corporate lesson, the big bank have the more potential to fail because they are deal with the things. Another thing is, the third one is, the corporate one is the concentration, and the failure of the small, other corporate is the failure of the small institution may lead to the may have the contagion effect to the bigger bank, and the bigger institution also may fail. So these are the answers you had to give for this the 2019 September questions, and there are some other questions also. 2019 March, actually I stopped with this considering the time, and we will see these balanced questions at the end of this class. Actually, last two sessions, the last two session of this semester, I will have then only a past paper question. At that time, we can cover the balance of the question. If you have any questions, I can answer. Otherwise, I will just wind up this class. Okay, thank you so much. So we will see the next class with the next new topic. Thank you so much.